Good afternoon, everyone, and thank you for joining us on such a lovely day here in Belfast anyway. This is our second webinar in our series of financial wellbeing webinars that we are running in association with Evelyn Partners. The aim of these webinars is slightly different than anything we've done before, but it is to help our members boost both their advisory capabilities, but also look at their own personal financial wellbeing. We had a great turnout and super feedback from our first in the series, which was on pension tips, and that is available over on our website if anybody missed it. Today's session, I'm sure, will be equally well received. Today's session is entitled Professional Wellbeing, You, Your Clients, Your Team, and it's going to focus on some key aspects of financial wellbeing with some top tips from the experts at Evelyn Partners. I am delighted to welcome back Alison Dean, Chartered Financial Planner, and Aaron Carey, who is an investment manager at Evelyn Partners. And today they will also be joined by Alison Fitzsimmons, who is the Private Client Business Development Director for Northern Ireland. Alison is passionate about financial wellbeing and works closely with many professional firms delivering programmes to support their people. Alison is going to host today's session for us. So just before we get started, I would like to mention that the session will be recorded and a link will be sent around to everybody who has registered for the event, so you can watch that afterwards, and the slides will also be available. As I mentioned earlier, there is a great selection of recent webinars up on our website at charteredaccountants.ie/Ulster. I would just like to thank Evelyn Partners for hosting this series for us. We are really delighted to be working with you. As we go through the session, please feel free to put any questions that you may have for any of the speakers into the Q&A box at the bottom of your screen, and we'll do our very best to address those at the end of the presentation. So for now, I would like to introduce you to Alison and hand over to her. Thank you very much.
Thank you very much, Sarah. And good afternoon, everybody, and thank you for joining us this afternoon. We're absolutely delighted that you've taken the time to join us to think about financial wellbeing. As Sarah's mentioned, I'm Alison Fitzsimmons, Private Client Business Development Director for Evelyn Partners. As we've already positioned, today's topic is all about financial wellbeing, and it's something that we at Evelyn Partners are passionate about. It's just so important. We all want to enjoy life, provide for our families, and hopefully retire one day. So feeling stressed or overwhelmed about your finances is going to impact on personal wellbeing. And this can be a particular problem for professionals, with a recent survey by the Lawyer magazine suggesting that almost 90% of their respondents said they were too busy looking after their clients to think about their own financial planning. So this is something that we want to improve. And at a corporate level, we're working with a number of professional firms to design and deliver bespoke programmes focused on financial wellbeing for partners and staff. And on a personal level, our call to action this lunchtime is just to take a little bit of time to think about your finances. Give yourself that same peace of mind that you give to your clients, that you're making informed financial decisions. So on to the next slide, please. The agenda for this afternoon. So the idea behind today's session is to really just provide you with some key information to help you feel empowered to take better control of your financial future. And of course, today's information is relevant to you personally, whether employee or partner, and also for when you're advising clients. The session will be led by Alison Dean and Aaron Carey from our Belfast office. We're expecting Alison and Aaron's presentation to take around 40 to 45 minutes, leaving us about 10 minutes for questions from you, our delegates. So, the usual caveats do apply about network connections. If there are any hiccups, please just rejoin using the same link as before. As Zara's already mentioned, we're inviting questions and comments throughout this afternoon's presentation. Please use the Zoom Q&A function if you'd like to ask anything. This also allows us to follow up any questions that we run out of time to answer live. So into the important information on the next slide, please. As always, we need to highlight the important information. Tax rates and reliefs are dependent on individual circumstances, and as we all know, can be subject to change. The webinar is not a personal recommendation to invest or to take a particular course of action. If, of course, anyone on the call would like to speak to one of the team on a personal basis or in relation to a client scenario, we would be delighted to hear from you afterwards. So on to the next slide, please. Evelyn Partners is a long-established UK-wide investment management and financial planning business. We're trusted to look after more than 54 billion on behalf of our clients across the country. We look after clients at all stages in their life and career, whether that's a graduate just starting out in their CA journey to a senior partner considering retirement in a few years' time. We operate a number of specialist areas, including advice to business owners, to those affected by divorce or serious injury, and we have a dedicated charity investment management team. We're also very excited to have recently moved into our new Belfast office at the Ewart. And so now, just to introduce you to our main speakers for this afternoon, Alison and Aaron. Alison Dean is a chartered financial planner based in our Northern Irish business. She has 20 years' experience helping clients to achieve their financial goals. Alison is a member of Resolution, supporting clients through divorce or separation, and is a member of Women in Business. Aaron Carey is a member of the Chartered Institute of Securities and Investment, and he's well on his way to becoming the most qualified investment manager in Northern Ireland. He manages a range of investment portfolios, both for corporate and private clients. He also manages business relief qualifying AIM portfolios. He's a committee member for Young Leaders Northern Irish Group. Alison, Aaron, it's over to you.
Thank you, Alison. So why is financial wellbeing so important? Well, the following statistics show what a difference it actually makes. 55% of working age adults do not feel that they understand enough about pensions to make decisions about saving for retirement. Professionals need help with financial wellbeing, and there is a clear link between wellbeing and productivity. Money is the biggest cause of stress in the UK. Over a quarter of adults feel stressed about finances every single day. Almost 1 in 5 adults would describe their financial well-being as poor or very poor. 61% do not focus on the long term when it comes to money. And 47% do not feel confident about making decisions about financial products and services. 51% couldn't last 3 months or more without borrowing if they lose their main source of income. I will now pass over to Aaron to talk to us about the wellbeing life cycle.
Thanks, Alison. So those are some startling statistics. Financial wellbeing is a broad topic, so we have to account for individuals at different stages of their financial life cycle. Young professionals can be laser focused on that early stage career growth. There is a lot of change at this point, for example, mortgages and marriages. It's easy to miss the fact that due to compounding, money invested at early stages does much of the heavy lifting by the time somebody comes to retire. Focus for young professionals should be on having a good handle on your finances and having a plan for them. The developing career person might be someone in their prime earning years. Material bonus packages, maybe a transition to self-employment, maybe an inheritance, and other such financial lumpiness can warrant a formal plan. Making the most of allowances and tax efficiencies is important at this point. And the safe landing into retirement clearly stands out as its own financial microclimate. Careful planning to examine the next 30 years of your financial life is key at that point. Finally, and less considered but very common, those who have been divorced, those who have taken a material amount of time off or have been ill or seriously injured, or those who experience other instances of financial instability can be derailed from their financial plans. So our finances are connected to every element of our personal life. Events change the course of history, and indeed the same can be said about events changing the course of our lives. And our finances are a big part of how we react to events. Where we're well positioned to financially maneuver, we can hope to react well to the unknown, whether that be illness, divorce, or bereavement. And in fact, we can also capitalise on opportunities that appear, perhaps with a house purchase, a career move, or the likes. From an employer's perspective, Money and Pension Service says that productivity in the workplace is directly linked to financial well-being. In 2018, 11% of UK workers reported they had experienced a fall in productivity at some point over the preceding 3 years as a result of their financial situation. So, as mentioned, headwinds and opportunities exist. Some examples are on the screen, and I would personally draw out lack of time and lack of action. People are generally busy. Between growing our careers and trying to stay fit and healthy, financial well-being can fall between two stools. It's the easiest thing in the world to leave until next month. But it is the thing that we rely on day to day, or indeed what we fall back on when we need it most. And good financial well-being isn't just that sleep at night and saving for retirement mindset. For those who want optionality in their careers or want to be able to take opportunities in their lives like starting a business, you need to have your finances in order to give you the best chance of being ready when those opportunities knock. So all that said, what does financial well-being actually consist of? We've broken it down into some key topics and we'll address each of them in turn. Roughly speaking, they are prioritised. For example, we see protection as top of the list of must-haves. And during the presentation, we'll ask you to rate yourself on each of these aspects, but more on that later. So, starting off with the holistic overview, Alison will break down making a plan for us.
Thank you, Aaron. So, where to start? What should be within your financial plan? Start with, what are your goals, your objectives? What do you want to achieve? By when do you want to achieve your goals? How much are they going to cost? How will they be funded? And ask yourself, are they realistic? And then circle back to when you want to achieve them by. It could be that you need to save longer than you initially thought. It may even be that some goals are unachievable. And that is when it's good to say, well, is this a realistic goal? A clear financial plan will set you on your journey. Next slide, please. I think it's a very good idea to think of your money in 3 pots. And pot number 1 being an emergency fund. I would recommend 6 to 12 months net expenditure. So if you're spending £2,000 per month, then I recommend holding a minimum of £12,000 to £24,000 in a cash accessible account. And the reason for this is that life happens and things go wrong, such as cars break down, house issues. So having that emergency pot of money can stop someone using a high interest credit card or borrowing money when things have not gone according to their plan. Then when you've got your emergency fund, focus on pot number 2. So pot number 2 would be holding money for planned expenditure. If you look at the next 3 years, do you have plans to change your car, an expensive holiday, home improvements, children's weddings, or children's universities may be on the horizon? And when you save the money for your plans, this money should then be held on deposit, yielding a high interest, yielding a high interest where possible. Now, pot number 3, if you are lucky and you are left with disposable income or a cash lump sum, then you could divert the money into your pension. Or if you're maxing out your pension, contribute to an ISA. So this would be your longer term money, which then be your nest egg, your retirement money. And now I'm going to pass on to Aaron, who is going to score us on our financial well-being.
Thanks, Alison. So, as we mentioned, we'll be asking attendees to assess themselves as we go through. If you have some paper and a pen to hand, I'd suggest drawing yourself a big pentagon with a dot at the centre representing a score of 1 and the corner of the pentagon representing a score of 10. As you can see, we've labelled each corner of today's main headings. Simply consider whether you're a 10, so in the case here of making a plan, you have a robust plan in place and regularly review all aspects of it and give yourself a 10. Whether you're a 5, here that being you have a plan you have a plan but tend not to refer to it or review it, or a 1, i.e. you carry out financial transactions on an ad hoc basis with no real plan, or indeed if you think you're a 6, a 9, a 2, whatever best defines where you are with that. So we'll do this for each heading as we go through. So now back to the content. Let's dive into the detail of a key area for us all, personal protection.
Thanks, Aaron. And yeah, this is a key area. So we've talked about having a plan and having 3 pots of money. What can make your plan vulnerable is not having the correct protection in place. So start off with, think about your income and ask yourself, if you are off work sick, what does your employer pay you? After your work stopped paying you, then what is the plan? What do you do? If you were self-employed, do you have a policy in place that you can call upon if you're sick? Now, there is a policy called income protection, and this covers your income if you're off work sick, and it will pay you a monthly income until you return to work or the policy expires. Next, protecting your debts. If you have a mortgage, are you covered for life and critical illness? Is your home protected? Because if someone dies, the last thing that they need after losing a spouse is to worry about money. Or if someone has a critical illness, they don't want to worry about their mortgage. They want to think about getting better. After you've protected your income and debts, it's always good to have additional life cover. Check if work pay you death in service, because if someone loses a spouse, they may not want to go back to work. They may want to stay at home with their children. Also, critical illness policy. So this provides a tax-free lump sum when diagnosed with a serious illness. This then gives breathing space for someone. It takes away worrying about money. Having the correct protection policies in place is absolutely key, because without them, you will use your emergency fund or you're going to borrow money, and then the wheels will completely come off the financial plan. And I'll pass to Aaron to talk about wills next.
Thanks, Alison. So it's worth a brief word on will. Whilst not directly financial, they are key to financial well-being. Intestacy, which is effectively if you have no will, how the government will decide who gets all your assets when you die. So intestacy has some very basic rules, and as a result, can end up with some rather unfortunate outcomes, particularly where extended families are involved. So, for example, where there's been a divorce, or a widow or widower remarries and then maybe has more children. Where a younger couple as well are living together long term and are as yet unmarried or don't intend to be married, and one of the two of them has more or all of the assets, again, a will ensure your partner's protection in a catastrophe. So similarly, but separately, when it comes to pensions, you should have an expression of wish in place. This will name somebody who you would like your pension to go to if you die. This isn't always set at the outset of having a pension, and you may need to actively go and add this person as your expression of wish via whatever online portal your pension provider has. This is very important and easily missed.
Managing debt. So part of your plan could be to clear debts earlier. So first, focus on your expensive debts first, which is normally credit cards or store cards. Then if you have disposable income, some could be diverted towards your mortgage. Always good to check first if you can overpay with the lender though, but most will allow you to pay 10% off the balance each year without a penalty. And people who are in the good position of having no mortgages or loans and have their emergency fund and planned expenditure, it's important to invest your money in your pensions and ISAs, as you want your longer term money to keep up with inflation. And I'm going to pass over to Aaron to see how we score in this section.
So, how did you score? If you think that you have a full suite of protection plans and you review those regularly, then give yourself a 10. If you have some plans in place, but you maybe haven't reviewed them in a while, give yourself a 5. Or if you have no protection plans or aren't aware of any, give yourself a 1. And again, if you're better defined as a 6, a 9, a 2, whatever, then give yourself that. So moving on to our next topic then, savings and pensions. So to start off, some food for thought. Depending on what stage of life you're at, you are likely to live until you're 80, or indeed well into your 80s. This ONS data is now 3 years old, and goodness knows what these figures could be by the time we actually make it to 80. So it could be said that to be prudent, you should plan to live to your 90 plus years old. For those with ambitions of retiring early and could feasibly expect a 30 to 40 year retirement, this section is absolutely vital. So the state will of course help you with your retirement, but more is required to have an adequate, comfortable, or indeed a good retirement. We'll focus on pensions here today, but ISA investments, rental income and other assets, as well as income from your partner and maybe an inheritance will all form part of this. To bring this all together, it can often be beneficial to speak to an advisor about cash flow modelling.
So the state pension. Now the state pension is the bedrock of retirement planning, and it's currently $10,600 per year. Some people may qualify for more than this as they have additional state pension benefits from many years ago. Now you need at least 10 qualifying years for any benefit at all. After 35 years, you will receive benefits from the full amount, which is the $10,600. Now, the flat rate of pension recently increased by 10.1%, so that makes it £203.85p per week. The amount of state pension increases annually by the higher average earnings, CPI inflation, or 2.5%, which is called the triple lock. And it's always worth completing a state pension forecast. Now, you can check that online or by a form called BR19. Next slide, please. So, the state pension age. Currently 66 for men and women. Now, if you were born after April 1960, it will be 67. And after 1978, it will be age 68. And watch this space, it's probably going to increase again in years to come. And the next slide, please. So paying into your pensions, so paying into your private pensions. So there's no limit on how much you can pay into your pension. It's the tax relief that is limited. The amount that you can contribute each year is generally restricted to the lower of your taxable income or the annual allowance, which is £60,000. So an example is, if you have a salary of £40,000, the maximum you can contribute is £40,000 gross per year. And if you have a salary of £100,000, the maximum you can contribute is £60,000 gross per year, which is your annual allowance. Now, you may be able to use carry forward. So that's an unused annual allowance from the previous 3 tax years. And to give an example of this, if somebody worked out that they had carry forward of £100,000 and their earnings in this tax year were £80,000, then they can only pay in the £80,000 because you cannot pay in more than you earn in the tax year. Next slide, please. So the annual allowance. The annual allowance is the most that you can save without a tax charge. And if there is a charge, it will be taxed at your marginal rate of income tax. So last year it was 40,000, and this tax year it's been increased to 60,000, and that's been a real welcome change. Also, another point to add is that pensions are currently accessible from age 55, and there are plans to increase this to age 57 from 2028, and I would say it will probably rise again after that. Next slide, please. Okay, now a very popular question that I get asked is, how much will I need to live on when I retire? And there really is no right nor wrong answer on this. But to give you some examples, try and bring it to life. The Retirement Living Standards website has published the following guidance. To live a moderate lifestyle and to retire at the age of 68 on an income of $23,300, including your state pension, you would need a pension pot $224,500 to top up your state pension in order to achieve the income of $23,300. Now, for a comfortable lifestyle, which they are saying is $37,300, which again assumes you are receiving the state pension, you need a pension pot of £514,020 to obtain the figure of $37,300. And the next slide, please. So what about taking benefits from your pension? Now, before pension freedom was launched in 2015, you only had 2 ways of taking your benefits, a scheme pension or an annuity. Since then, since 2015, taking your benefits, a lot more flexibility around it. So you can take flexible access drawdowns, so leaving your money invested and benefiting from investment growth and tax efficiency, managing that income yourself, so you increase it, decrease it whenever required. And this now would probably be the most popular route. You can take your pensionable, so another option, you can take your pension commencement lump sum, 25% tax-free, and leave the rest invested. You can take uncrystallised pension lump sums, referred to as UFPlus. So when you take what you require, so if you had a pot of 500,000 and you just required 100,000, you crystallise 100,000 only. And then 25,000 is tax-free, and the remainder is taxed at your marginal rate. And then next, annuities. An annuity is purchasing yourself a guaranteed income. And the rate that you get is dependent on your age, your health, if you smoke, if you've ever smoked, drink alcohol, or you have any health issues. And you can add on inflation proofing to your annuity, add a dependence pension if required. An annuity is for someone that is not comfortable with risk and likes to know exactly what they are receiving in income each month. And I'm finding that a blend of income drawdown and annuity is becoming very popular because this provides flexibility and a guarantee. And the next slide, please. So annuities, they're becoming popular again, as they're a lot better value now than they have been in previous years. And this is due to the gilt rates increasing. So to give you an example, to provide an example of a 65-year-old male on a £100,000 pension pot, he could annuitise and he could receive £7,337. So 100,000 will get him £7,337. Now in May 2018, this was just 5,482. So annuities can play a fundamental part in retirement planning, and it can be, and you, as I say, you can mix them with flexible access drawdown. So next slide, please. Another question that I get a lot is about consolidating pension pots into one pot. And this can be a really good idea, but care is needed. So I'll call out some of the disadvantages first. Now, in some of the older style pension contracts, I have seen guaranteed annuities built in, such as maybe even a 14% annuity. And if the client had transferred it out, he would have lost that rate. Now, look, I was able to stop that happening, but you've got to be checking for guaranteed annuities. Now, there can also be enhanced tax-free cash. So that means they would get more than the standard 25% tax-free. So that could be a benefit built in. And you can have some that have got with profit funds, they've got bonuses guaranteed built in. I've seen some that are paying 4% guaranteed each year. So you don't want to be losing these benefits. 80% of my time would be spent retirement planning, and I've managed to stop people making some very costly mistakes. On the other side of the coin, some of the advantages are it's a lot easier to manage, just having one pot as opposed to various pots. You can get better performance by switching the funds. You can lower your charges, and some of the older style contracts are not set up for flexible access drawdown. So eventually you'd need to change it anyhow. So my advice would be careful with consolidation, and if in doubt, seek advice and speak to us. Next slide, please. And then pre-retirement planning. So firstly, establish what income you require. And sometimes this is hard to sort of guess, but as much as you can. And then factor in any large capital expenditures. Work out what are the values of your pension pots, what you've got, what's your attitude to risk, and does it match the current risk within your pension? And then cash flow modelling, fantastic tool, and find out how long your money is going to actually last you for, and if you're going to run out of money or you're going to be comfortable. And we would do a lot of cash flows. Make yourself a checklist of where you are and where you need to be for when you retire. And next, I'm going to pass over to Aaron to score us.
Thanks, Ali. So again, we're just going to look at how we scored in that section. So if you have an ample emergency fund and a pension that is on track for your retirement goals, maybe give yourself a 10. If you're saving and add to your pension, but it's best described as ad hoc, give yourself a 5. If your savings vary materially and your pension isn't something maybe that you think about that much, give yourself a 1. Or indeed, anything in between. So our next section is about tax efficiency. Obviously, we want to minimise tax payable. As you'll all know, by transferring assets between a married couple, we can make use of our partner's allowances as well. So we're not leaving any money on the table. Assets can be moved freely back and forth between married couples, so no capital gains tax is payable on the transfer. This is helpful to use up your partner's ISA and pension allowance, use their capital gains tax allowance, or indeed their dividend allowance, etc. And if they are a lower rate taxpayer than you are, clearly they'll pay less tax on income and gains from the asset. Another separate aspect to consider is that some assets have their own innate tax benefits. For example, UK government bonds are capital gains tax free when held by individuals and currently yielding over 4%, indeed some of them nudging at 5%. So be aware of what assets are available to you to manage your tax. BPR qualifying assets like AIM investments also fall into this category. So this slide is really for your own reference when you come to download the slides at a later time. We all know that tax rates have become less favourable recently, in particular capital gains tax, which effectively halved this year and will halve again next year. But the pensions allowance have increased from 40,000 gross to £60,000 per annum gross. So pensions have gotten that wee bit more important. A bit of a shorter and sweeter section on tax efficiency. If you do all these things already, maybe give yourself a 10. If you do some of these or partly do all of these, give yourself a 5. And if you do none of them or aren't aware of them, give yourself a 1. Finally, on to my favorite category as an investment manager, investments. So once you have your plan made, protections in place, you have your savings and pensions in place, noting that, of course, you also invest inside your pension, and you're making use of your allowances, we need to know how best to invest to make all of those great actions worthwhile. For example, putting money into your ISA and getting the benefit of that tax-free growth and income inside it is great, but the money inside should then be utilised as best as possible by investing inside the ISA for your future self. So I thought I'd start off with a handy rule of thumb. The 4% rule was invented by a US financial advisor who used 50 years of historic data to identify that investing in a portfolio of 50% US stocks and 50% US Treasury bonds, bearing in mind this person was American, so he was focused on US assets, and only withdrawing 4% of the original value of the pot per annum. So if the pot was 100,000, just taking £4,000 out per annum, returns were adequate enough that the portfolio lasted over 30 years, including allowing for inflation. So if we retired at 65, that would do most of us the rest of our lives. So the thing here is the mix of investments growing at the same time as you're withdrawing. That's the difference between the pot lasting 20 years, i.e. 100% divided by that 4% initial withdrawal, versus lasting over 30 years, with the growth chasing your withdrawals. So when considering how to invest, we would suggest making use of this table to get the juices flowing around what best works for you. When having initial meetings with clients, I will ask them about the left-hand column headings, in particular risk, time horizon, and investment objective. I've put down a non-exhaustive list of questions here to consider. Taking the first one there as an example, i.e. can I reduce costs of investing by amalgamating different pots? If you have a few different pensions and a couple of ISAs, for example, with different providers, and maybe your spouse is the same, by amalgamating your pots and opting to be treated in a mandate with your partner for investment management, you could be looked at as one large pot for investment purposes and receive favourable rates and charges on its management. So effectively, by bringing different pots together would mean saving you money. Other questions I draw out here are, do I hold underperforming funds? As often, people just won't check this. Could I use short-term assets like bonds for cash management? Because I've seen individuals that have a lot of cash at the bank that could be earning a lot more interest on it by investing in assets that are government-backed and arguably then safer than banks. I will touch a wee bit on that later on. For the younger contingent in the audience, does my long time horizon allow me to take more risk than I currently am taking? This is because many of us just opt for the default fund in our pensions. These can be very low risk and low return, which doesn't align with a young person's long time horizon and so ability to take longer term, higher risk. So the goal of investing is clearly to grow wealth, but we also need to preserve wealth. If you're edging towards retirement and expect to make use of your pot, you don't want to risk a material drop in the value of the pension. So the later in life you are, you may be more focused on that preservation element. 4 important titles to be aware of when investing are on this slide. I'll dive a bit more into the other 3, but just want to touch briefly on the third one there, real. It's important to take account of what return you're really getting. Clearly, inflation is a factor here. So if you're getting a 7% return, but inflation is running at 5%, then taking those 2 away from each other, you're actually really only making a 2% return in real purchasing power terms. But also importantly, costs and taxes come into it in a big way. You need to be aware of the real cost of investing. If you're paying too high fees for the return you're making, your returns will suffer significantly in the long term. And finally then, dealing costs of buying and selling inside a portfolio is an easy one to miss and can have a big impact. So to that preserve piece, to preserve wealth, we need to focus on downside risk. For many, investing means stocks and shares. The reality is that modern investing is multi-asset, making use of bonds, gold, hedge funds, infrastructure, property, and more. By making use of different assets, we can expect them to move up when stocks and shares are moving down, thus balancing out the portfolio's performance and alleviating a portion of the downside risk. To flesh this out in real numbers, the graphs on the right-hand side show how Evelyn Partners' various risk profiles have performed versus a pure equity benchmark in terms of downside protection during periods of big market falls. For example, during the COVID crisis of 2020, which is the bottom right-hand corner graph there, where the UK market, stocks and shares, fell 25%, but our portfolios fell a maximum of 13.7%, which kind of shows you that downside risk. Taking account of that downside risk is very, very important. So time, or as we like to say, time in the market versus timing the market. People will often ask me, Aaron, what should I be investing in right now? Expecting me to say gold or Apple or China. The reality is that timing the markets is nigh on impossible, and literature backs that up. This study from Morningstar shows asset class returns over various calendar years up to 2021. Each asset is a different color, and the study covers government bonds to gold to emerging market shares and everything in between. It then ranks them each year based on their total return in that year. For example, on the very right-hand side in 2021, the best returning asset class was US shares at 28.1% up on the year, and the worst was gilts at minus 5.2% that year. So what am I taking from this? If we accept that market timing is almost impossible, and from this array of mixed returns, you can really see why, then the only solution is to hold a balanced, well spread out basket of assets for the long term and expect to get a balanced long-term return. That long-term view allows us to ride out the bumpiness and unpredictability year to year that you can see here. And by taking that long-term view, we can hope to benefit significantly. It wouldn't be an investing PowerPoint without a long-term growth slide. This graph shows the returns of the global stock market since 1990, and £100 invested then would be worth about £1,300 now, approximately at 7.5 to 8% return per annum. Clearly, there are bumps in the road, whether it be a war, a bank crisis, political ructions, or more recently, a pandemic, the markets bump and then they rally. But changing the pace slightly, to finish up the investing section, I thought I would actually look at the shorter term. Due to increased interest rates, the returns on bonds have been increasing and become very attractive. Bonds are simply debt. You lend a government or a company some money, they pay you an interest rate for a set period of time, and then they give you the money back, as with any normal loan. UK government bonds, known as gilts, are very safe bonds because you're lending to the UK government, who will back that debt, making it arguably even safer than money at a bank. As a bonus for lending to the UK government, this debt is also capital gains tax free when held by an individual. With heightened interest rates, very short-term bonds are yielding nearly 5% at the moment. And that can be a tax-free 5%, unlike interest at the bank. As you can see from the graph, which shows interest rate expectations for the next 12 months, higher interest rates are expected to continue. So we've seen a lot of activity in this space for clients. We've seen a lot of activity in this space from clients who have large cash balances and want to get a good return on that cash in a very safe way. So that's a bit of food for thought for shorter term. So how did you score then for investment? If you understand the detail of what investments you hold, maybe give yourself a 10. If you have an understanding of the benefits, but maybe not the detail, give yourself a 5. If you're not familiar with investments, give yourself a 1. So that's our run through of the main topics complete. Hopefully you should have a bit of a map of where you are with your financial well-being. This will help you identify some weaknesses if you have any, and maybe areas for improvement. So that's really the slides finished for today. Thank you very much for taking the time to speak to or to listen to us. I'll welcome Alison back to the screen for questions.
Thanks, Aaron, and thank you to you and Alison Dean for a fantastic canter through all aspects of financial well-being. Really useful discussion this lunchtime, and a good number of questions flowing into the Q&A box. Aaron, I've got the first question to you. I think hopefully you should be able to answer this one quite quickly, picking very much up on where we finished on short-dated gilts. You explained that there was real kind of tax advantages here. Can you explain what these are exactly and how this works?
Yeah, that's an interesting one. When held by an individual, you or me, Alison, these bonds are capital gains tax free. So that's interesting because most people use them in a direct comparison with interest at a bank. So looking firstly at the bond, as I mentioned, with any loan, you could be getting that 2.5%. Like if you lend to the government and they pay you a 2.5% interest rate, then you're getting your £2.50 on every £100 that you give them every year. But if instead tactically you buy gilts with very, very low coupons or very, very low interest rates, you still have to get that return. You still have to get that 5% that I mentioned. So the way that works is you buy the bond very cheaply, so maybe at £95, and then over time you will accrue the interest via a capital gain, and then they'll give you back your £100 at the end. So that gain of about £5 equates to your 5% return. So when held by an individual, as I say, that gain is capital gains tax free. So when we compare it directly to interest at a bank, which is charged, you're charged at 40% if you're a higher rate taxpayer on interest from the bank. We need to do a like-for-like comparison. So if you wanted to get a similar return to what you're getting in the gilts in the bank, you would actually need an 8% and a bit return. So that's where bonds really come into their own in terms of tax, because of that net return or that lack of capital gains tax, you're actually on a like-for-like basis making a very, very significant return, especially when compared to what you would need at the bank in order to get the same return. So that's how that works.
Thanks, Aaron. That really is quite compelling stuff. Thank you for expanding. So, Alison, we've not heard from you in a little while, so I would like to direct the next question to you, and it's something that we're asked very, very regularly when we do financial wellbeing updates. We've spoken a bit about the benefit of ISAs and their tax efficiencies, and we've spoken a lot about the benefits of pensions. So if it was a one or other, Alison, where should you be diverting your any excess money, into an ISA or into your pension?
Yeah, I get that a lot. Now, there is no sort of right or wrong here, but sorry, you wouldn't be making a mistake either or. But I always deem pension as king, because you are getting that uplift going in. So you're getting the tax uplift going into it. It's going to grow tax-free inside the wrapper, as I call it. So it's growing there tax-free for you. And then when you draw down, you're getting that 25% tax-free as well. Now, it is going to grow tax-free inside your ISA as well. And when you pull down from the ISA, it's going to be tax-free, and it's not going on a self-assessment. But theoretically, we would be saying pension first, because you go getting the tax lift and you're going in. So you are better to put it into your pension. And then if you've maxed out your allowances and you're in that fortunate position, I would then be saying, then once you've done your pension, look over to your ISA next. Thanks, Al.
Thanks, Alison. That's really useful. Both obviously very good strategies, but clearly pension has more of the tax efficiencies at the outset. Aaron, I'm going to come back to you for this next question. And you showed a very helpful chart as we went through there, showing some of the kind of shocks to the stock market that we've experienced over the longer term, really. But focusing in a little bit more on funds, how would you be able to tell if a fund, a specific investment, is underperforming?
Yeah, that's a fair question. I suppose I get a similar question at the last seminar we ran for this group. So I would point you in the direction of the fact sheets. Any fund that's regulated in the UK and can be bought by UK investors has to have a fact sheet, which is literally just a PDF, 2 pages, kind of giving all the information on the fund, including its performance in the short, medium, and longer term. So what I would say to people who are interested in what they're invested in, either in their pensions or otherwise, and wondering, is this fund actually good? Has it been performing well? I would suggest that you simply go and find the name of that fund, Google it, find the fact sheet, just say name of fund and fact sheet into Google and you'll get it. Look at the fact sheet and see how it has performed over the medium and longer term. And that will just be as simple as looking at its graph, which should be on there, and seeing whether it's beating its benchmark. I would say as well, it can be beating its benchmark. And when I say benchmark's like a comparable index that you would compare the fund to see whether it's actually doing well versus its peers or not. If it's beating its benchmark, it might be doing so by taking too much risk, is another thing. So if the fund is, if the line graph for the fund is above its benchmark, but it's everywhere, it's just bumping up and down, taking risks left, right, and centre, and just so happens to be doing well off the back of it, that's not a particularly well-performing fund either. That is underperforming on a risk-return basis. So you need to be aware of, one, is it performing well in absolute terms, i.e., is it beating its benchmark? Is it doing what I want it to do? Is it going up? And secondly, then, is it doing so in a risk-adjusted way? Is it, if it's taking too much risk, then ultimately what's going to happen someday is you're going to try and sell the fund and realize actually one of those bumps has went down and you're doing so at a bad time. So that's where we would say look at it on an absolute basis, but then also look at it on a risk-adjusted basis. Is it too bumpy? So to answer your question, the fund fact sheet.
Thanks, Aaron. That's really, really helpful. So moving away slightly from investments for the next question that's come through, and Alison, I'll come to you with this one. Maybe difficult to answer specifically, but you've talked a little bit about the importance of protection and income protection being part of this. But can you elaborate on how long would an income protection policy pay out for?
Yeah. So with an income protection, let me try and bring it to life, basically. But let's say that somebody has their employer, well, civil servant, their employer then will pay, maybe that's the best analogy, but somebody's employer pays them for 6 months. And they're saying, right, okay, well, I now have no other money or just my employer's sick pay. So what do I do after that? So you can start an income protection policy and you can say, well, I'll have a deferral period for 6 months. So I don't need it to pay out because my employer's paying me. And you can then get that policy to pay you. Let's say somebody started at age 40 and want to retire at age 60 until age 60. So that's an ideal situation, a blue sky situation. But it could be that somebody doesn't have the disposable income to take it to age 60. And in which case I can then say, okay, well, let's do it for round your budget. So it could be that we could just do it for 5 years. It may be that the budget just warrants 2 years. So actually you can amend it to suit your own pocket. But again, in a blue sky situation, you would take it to retirement. So you can amend them and you can adjust them and you can make them very affordable. Thanks, Al.
Thanks, Alison. So sticking on the protection theme, and it comes back to the first question I posed to you, if people seem to like this either or theme. So protection is clearly very, very important, but which would you do first, protection or build up that emergency fund that we spoke about?
Protection. So with the protection, it really is your foundation of the house. That's actually how I look at it. It's the foundation of the house. And if the protection isn't in place and then something goes wrong, and things do go wrong, then the first thing you're going to do is call on your emergency fund. And then your emergency fund's gone because there was no building block in place, no foundation. And then the next thing you know is that somebody is then borrowing money. And all of that financial plan has just gone to the wind. And I have seen this happen a lot, and especially with self-employed people, because there's no employer to pay them. There's no death in service. There's nothing. So your protection is first and it is key. And people make so many plans for the future. And I've got a couple recently that have come to me. She was doing a cash flow and they were doing their cash flows with me and we were working it out to the penny, saying, right, okay, so this retirement is going to look good. Didn't really want to focus on protection because they thought, well, there's savings and investments there. And unfortunately, something has gone wrong, a serious illness, and now payments are being made for consultants and things. So it really is good. Start with your foundation and then everything else. So that was the long-winded answer to that one, Alison. Protection.
Thanks, Alison. And a long answer to what was a very clear choice in that scenario. So thank you for elaborating and sharing. And I think we've made it through most of the questions. I'm conscious of everybody's time. We've got 5 minutes to go. So I think we'll look to wrap things up at this point, and just thank you all of your delegates for attending and joining us this lunchtime. Should anything else come to mind, please do keep in touch. We'd be absolutely delighted to hear from you. Big thank you again, Alison and Aaron, for sharing your thoughts on financial wellbeing. I've certainly found that really useful over lunchtime today. Huge thank you to the Chartered Accountants Ireland Ulster Society for taking the initiative and showing such interest in this topic. And we've been delighted to work with you on these sessions. And last but not least, thank you to all of you for taking the time out of your busy diaries to join us today. There would be no session without the audience. So we look forward to working with Chartered Accountants Ireland again, and to hopefully seeing you at more virtual and potentially in-person sessions.
That's great. Thank you very much. So just really to reiterate what you said there, Alison, I personally found it a very useful session with lots of useful takeaways. We're delighted to be working with Evelyn Partners, and we look forward to the next webinar in this series, which will be after the summer break, so probably in early September time. So watch out in your emails for details of that. So thanks again for the three of you all coming on today, and I just wish everybody on the call a good afternoon. Thank you.
Thanks, Sarah.
Excellent.